The Bank of Japan stunned global markets with its surprise announcement of a negative interest rate last month. Well, that change took effect today, and the central bank is hoping that the move will help beat deflation and boost local consumption. But will it actually bring desired effects? Kim Min-ji has this report.
Japan has entered an era of negative interest rates. The Bank of Japan announced a policy late last month, but it officially took effect on Tuesday. A minus 0.1% interest rate will now be applied to some of the accounts commercial banks hold with the central bank. The move, which was pioneered by central banks in Europe, is seen as a means to push down borrowing costs in hopes that people would spend more, save less, and stimulate inflation. Around 10 trillion yen, or roughly $90 billion in bank funds are subject to the negative rate, which makes up about 4% of the total funds held by the central bank. The change comes at a time when Japan has long suffered from deflationary pressures, pushing the central bank to take aggressive stimulus measures in recent years. Adding to concerns, its GDP shrank 1.4% on year in the fourth quarter. Worries about a slowdown in China and other emerging markets are also weighing heavy on Japan, which has been struggling with market volatility and an appreciation of the yen against the dollar. So it remains to be seen just how effective this latest measure will be.
The global economy is facing a downturn, and unlike when Abenomics was first implemented, the yen is not weakening as it once. The move will not be able to revitalize the real economy, although it may lift up the real estate market.
The Bank of Japan has left the door open for rates to fall further into negative territory. But some analysts point out that more drops won't necessarily have the same impact as the first cut. Kim Min-ji, Arirang News.